Hello everyone, a really warm welcome to you all, and thank you for joining us for today's webinar. My name is Heather Thorpe, and I'm with justfood.com, and I'll be the moderator for today's webinar. Today's expert speakers talking to you and talking you through this topic are going to be Brian Medley and Matt Ford, both from PrimeRevenue. So without further delay, I will pass you straight over to them. So hi, Matt, and hi, Brian. Would you both like to introduce yourselves to our audience?
Sure. Hi, everyone. Thanks for joining. Thanks for Just Food for hosting. I'm Matt Ford. I'm PrimeRevenue's Regional VP for EMEA and APAC. I've been with the company about 2.5 years, and I'm responsible for all commercial, strategic, and operational aspects of our core business in those regions. In my role, I'm fortunate enough to be working with 5 leading European food retailers, and our platform processes approximately 25 billion cost of goods sold per year for those retailers.
Great, thanks, Matt. And thanks, Heather, as well. We appreciate you hosting us today. Again, my name is Brian Medley, and I'm Vice President of the Americas at PrimeRevenue. And for the past 6.5 years, I've worked with the executives at some of the world's most innovative companies, including a number within the food and beverage industry and the packaged food sector specifically, to help them define and execute a strategy to unlock working capital from their supply chain to help support growth and innovation in the industry. So thanks again for having me today. I look forward to the discussion.
That's fantastic. So thank you. So I'll kick off then. There seems to be a lot of changes in both of the spaces with regards to what's driving M&A across the industry. So many of which are driving an uptick in M&A activity. So Matt, what trends are you seeing in the retail sector?
Well, I think the trend is kind of, as it always is keeping up with the continuing evolution of consumer habits. Over the last decade, we've seen the consumer start to eschew the big weekly shop at an out-of-town superstore, and we're now more than ever like a creature of comfort, convenience, optionality, and value for money. The ability to grab and go for our immediate needs and perhaps sort of take delivery of large consumer staples. But with that evolution, we're seeing sort of 3 big picture issues that I think most leaders in this industry are thinking about: the Amazon effect, the deep discount model, and private label brands. So I guess we could start with like the elephant in the room, Amazon. Amazon, it's an incredible story. I mean, they've got scale, an impressive distribution network, which will disrupt food retail in ways that we've kind of already seen, and many ways that we might not yet appreciate. So if we look at last year, like Amazon took the industry by surprise when they acquired Whole Foods, and an acquisition that has already realized several changes in the space. Whole Foods has given Amazon a bricks and mortar platform where they can diversify and sell their Amazon brands like Echo. It's open the ability to open up lockers for delivery and solves what the internet retailers have increasingly realized: you still need bricks and mortar when it comes to handling returns. But the Whole Foods may be the launch pad for Amazon to solve for fresh food delivery in a way that Amazon Fresh never really could. The Whole Foods store provides a more cost-effective way to take care of fresh products, act as a distribution hub for those groceries, and the brand cachet of Whole Foods means that a shopper might be more inclined to trust Fresh Foods branded Whole Foods more so than they might trust foods branded as Amazon. Amazon's also been able to sort of streamline the Whole Foods into becoming a more cost-efficient national retailer by centralizing their purchasing for suppliers. So some suppliers who credit Whole Foods as the birthplace of their new products might find it easier to scale without traveling region to region, but some small niche brands with less ambitious growth plans might feel sort of squeezed out. So every retailer in the world's got to compete with Amazon on those efficiencies. So what are they going to do? Well, most of the companies we're observing obviously slowed their store growth and focused on acquisitions and technology platforms. So, for example, Walmart with Indian e-commerce company Flipkart, Kroger and invested in British online supermarket Ocado and bought meal kit company Home Chef. And then the other companies like Sainsbury's have sort of turned to merger and acquisition. Plans to buy Walmart's Asda unit in a 7.3 billion deal that will make it the largest food retailer in the UK. And in a vacuum, looking at that strategy, it might not make the most sense, but in the context of last year's Argos acquisition, I think their ambition becomes a little bit clearer. Sainsbury's appear to be looking at combining the distribution network capabilities of Argos that already afford it better delivery services and many UK locations in the UK than Amazon Prime. Their non-food sales and their e-commerce capabilities. Combine that then with the Sainsbury's customer demographic and the acquired demographic from Asda, augmented with the key addition of Asda's non-food sales courtesy of their George brand, the picture becomes a little bit clearer. I think they're betting on that they can combine all these facets and present themselves as a multi-front presence that will compete with Amazon. And given the performance of their stock price since the announcement in April, the market seems to like their chances so far. But let's assume that for a minute that food retail can combat Amazon. They then have to contend with the impossible to ignore price war, which two European deep discounter grocers, namely Aldi and Lidl, are notoriously at the front of. Their ability to offer a limited assortment of products at very low prices is practically unrivaled in Europe. When Morrison's acquired Safeway in 2004, the likes of Aldi and Lidl were almost unrecognizable as food retail brands in the UK. Yet today they represent 13% of the UK market, spurred by an 80% growth since 2013. Their growing presence will likely be presented as one of the reasons the Competition's Market Authority should get comfortable with the Sainsbury's Asda acquisition. Our calculations tell us that the store disposable requirement from that acquisition will be in the region of up to 300 stores. And I'd imagine that these bricks and mortar sites will have some appeal to either Aldi or Lidl as they continue to grow their presence, and maybe even the previously mentioned Amazon. Aldi's deep discount approach benchmarks their pricing much lower than competitors, and the consumer's response has driven massive growth for the company. In the US, Aldi have pledged $5 billion to renovating existing stores to grow to 2,500 locations by 2022, which would mark a 700 store increase from today's footprint. Lidl, for their part, opened their first store in 2017, and whilst their early growth plans in the US have missed targets, you would still bet on a retailer that operates 10,500 stores in 28 countries to figure that out. The final trend is really quite interesting. Is where I think food retail has kind of woken up, and that's the searching for margin and customer loyalty through the expansion of more profitable private label brands. Private label brands have gained power and trust to influence the consumer's choice. 61% of consumers are purchasing more private label brands than they were 2 years ago. And Damon's most recent private brand intelligence report informs us that 84% of consumers perceive the quality of private brand labels to be at least as good as name brands, and that 74% believe private labels to be better value for money. But there's a last data point that's quite interesting. 53% of consumers say they shop at a store specifically for its private label brands. So if retailers can strengthen the private label brand offerings, they have an opportunity to find margin and develop that customer loyalty. And by way of example, if we take Kroger, a quick look at the recent headlines will sort of tell you that after a first quarter that was very strong and beat expectations, they published weaker than expected results for the second, and that hit the stock price negatively by about 10%. But look below that headline data, and I think there's reason that the market's reaction is that the market's reaction has been an overreaction. I think that outperformance of the private label brands needs to be considered. Kroger brands made up 28.2% of unit sales and 26.5% of sales dollars, both records. And that is led by 15% growth in Simple Truth and Simple Truth organic lines during the second quarter. In fact, Kroger Simple Truth Organics brand has reached $2 billion in annualized sales recently, making it the second largest brand in their stores. The company recently announced that they're going to pilot with Alibaba to sell this brand direct to consumers. And in CEO Rodney McMullen's own words, he believes the Simple Truth brand stands apart from competing brands. Smaller, natural and organic brands may compete on one piece of their overall brand, but not the overall brand itself. And this surge in private label brands has seen the industry, which remains highly fragmented, experience a rise in M&A activity, which in my opinion has not reached its zenith.
So Brian, what are you seeing in the packaged food sector?
Sure. So one of the things that we are seeing is that, the overarching megatrend that we see is that changing consumer tastes are driving a real transformation in the packaged food industry. And we've seen this for a number of years as consumers are looking for healthier, less processed options, but still want the convenience and the on-the-go options or the grab-and-go options for their busy lifestyles for themselves and their families. This, combined with the ever-increasing technology that consumers have available, is really shaping the future of the packaged food industry. And that's kind of breaking down into three different sub-trends that we're seeing, specifically repositioning in the marketplace, new product launches and innovation of those products in the market, and consolidation in the market. So when we talk about repositioning, we're especially seeing this in the snack and the frozen food sector, which right now is a bright spot in the packaged food industry. So as companies are seeking to meet the consumer demands for less processed and healthier foods, they're repositioning their brands accordingly. Conagra is an example of this in that it's been actively adapting to these changes. Last year, Conagra, for example, freshened up its Healthy Choice brand, giving it a new, more current look and feel, which has emerged now as a really standout performer in the category. As a result, the comparable sales for Conagra's frozen food segment went from a sharp decline prior to the refresh to now rising for 3 quarters in a row. Another example is Nestlé's Lean Cuisine. It's a great repositioning success story in their business. This brand has seen sales decline over $400 million between 2011 to 2016. So they decided to take action and make some philosophical as well as physical changes to the brand. No more diet speak, and instead they opted to position the brand around a healthy, organic, and a nutritious lifestyle. This, along with fresh marketing and new packaging, has resulted in Lean Cuisine being able to drive a $58 million sales increase in a single year. The next trend that we've seen, or sub-trend that we've seen, is the launch of new products and innovation. And packaged food is also seeing a renaissance when it comes to these kind of products and innovation. A few examples we'll give. One being Kellogg's. As they started a renovation or renaissance in theirs back in 2014 around Project K, and you see it continuing today with the introduction of the Joy Bowl smoothie bowls. It targets urban millennials with what it describes as the first packaged smoothie bowl. This is addressing both a changing taste as well as a changing lifestyle for on-the-go consumers. Yoplait followed suit with a similar tactic and has introduced a new high-protein yogurt, YQ, that appeals to consumers that are looking for healthier options that fit into that active lifestyle. Another notable innovation is the introduction of new meatless burgers, like the ones from Impossible Foods and Beyond Meat. These are catering to changing preferences and consumer demand for more options, both for a vegetarian lifestyle, as well as those looking for healthy alternatives, while still enjoying a more traditional food option in burgers. Impossible Foods burgers are now sold in chains, including Umami Burger and Bear Burger, while Beyond Meat's offerings are actually sold in the meat cases at Kroger, Albertsons, Ahold stores, and others. So we're seeing some big changes in that space too, even kind of crossing some barriers to what you would see traditionally in the market. Other recent innovations include the adoption and introduction of meal kits. So you have companies like HelloFresh and Blue Apron are capitalizing on the consumers that are wanting to prepare fresh and healthy meals for themselves and their families that they can still fit into a very active lifestyle where time is at a premium. Their meals are pre-prepped, pre-measured, and delivered in a very nice package straight to the door of the consumer. This new service is taking the pain out of dealing with going to the grocery store, standing in line, having to find a parking space, but still offers the convenience and time-saving option that today's customers have grown to expect without having to sacrifice the want of a fresh, home-prepared meal. To continue on that line of innovation, we see companies like Chick-fil-A are rolling out their own versions of meal kits, allowing customers to simply stop by and pick up a meal kit that they can prepare at home in minutes. All of these are examples that show how companies are not only responding to changes in preferences, but also to changing consumer groups and the larger buying power of those groups that have specific preferences or styles or eating habits, such as vegetarian options, paleo, younger millennials, people that are on the go with a busy lifestyle, etc. The third sub-trend that we've seen is consolidation. And as we discussed earlier, the need for new products and innovation and the requirement to meet changing consumer preferences it's really driving a massive consolidation in the packaged food industry. This consolidation ranges from mega acquisitions to smaller, more strategic buys. For example, Conagra has made a bid to acquire Pinnacle Foods for $8.1 billion, which is expected to close by the end of the year. Why are they doing this? Well, Conagra is trying to grab a bigger share of the fast-growing snack and frozen food markets. And with the closing of this deal, this will make Conagra the #2 U.S. frozen food maker, just behind Nestle. This is just one acquisition in a long list. Since 2012, Conagra has made numerous acquisitions, including Bertolli, P.F. Chang's, Raucourt, and Blake's. All of these representing investments in prestige, frozen, or the healthy organic food sectors, all new areas of expansion and innovation for Conagra. Another example is Kellogg's buying RX Bar for $600 million to continue the work that started several years ago by the Project K initiative to broaden its footprint into healthier foods. A third example I would give is it's really somewhat unique too, is General Mills buying the Blue Buffalo Pet Food Products Company in order to move into a healthier, more boutique food market, pet food, further underscoring the innovative ways that companies are connecting with their consumers. As a side note, we should point out that this uptake in M&A activity isn't just about the consumer. This activity is coming at a time when scale and negotiating power are really critical to the packaged food companies. Retailers are demanding lower prices so that, as we discussed earlier, they can compete with the likes of Amazon, Aldi, and Lidl, while high commodity prices and rising freight costs are continuing to squeeze their margins.
That's great. Thanks, Brian. Okay, now it's time for us to just put the focus back onto you guys, our listeners, just for one moment. We'd love if you could answer a very quick question for us. So on your screen very soon will be a poll. It's there now. So we'll get you in the next 30 seconds just to answer as honestly as you can which question is most relevant to you. So as you can see, it says, where are you making the most investment in the next 12 to 24 months? And there you've got a choice of acquisition, new product innovation, changing consumer preferences, or increased e-commerce pressure. So let's see. It's quite interesting. I'm sitting here watching you all vote. So come on, there's only half of you. So let's get the rest of you voting. It's really interesting to know. Okay. So I shall close this. So by the looks of it, 64% of you said new product innovation, which is interesting, and then followed quite closely, although with 18%, as acquisition. So new product innovation and then acquisition, with changing consumer preferences and increased e-commerce pressure, joined at 9%. So thanks for that. Okay, so it's going back to our speakers for today. It sounds like food retailers and packaged food companies have a few options. They can either build out capabilities to compete in this new landscape, or they can acquire them. So, Matt, what's your take on this?
Well, I think we're already seeing it, with Sainsbury's and the acquisition we discussed earlier, a number of the examples that Brian's brought to the fore. What we expect is, more of this as in the future as leaders define the strategies to the challenges we discussed. I think time to scale is going to be a critical consideration. Can a company afford to develop the market of a net new frozen food brand or a new organic range of products? Is it not easier to acquire? And the same can be said of positioning your business against Amazon. Do you build out a home delivery logistics network, or do you partner with or acquire a competitor that's already well positioned for these capabilities? I think more often than not, the acquisition option is going to make a lot of sense. But then the challenge, of course, is the funding. So the acquisition might be the better strategy, but that's going to have a much higher and more immediate impact on capital. So, however companies are wishing to proceed, I think they're going to be reviewing their need for liquidity and improved cash flow, and companies are going to be looking for the alternatives that augment or go beyond traditional options such as bank lending, new equity, or bond issuance.
Great, that's lovely. Thanks. Now, I'd like to learn more about your thoughts on this, Matt, but just beforehand, let's go back to the audience and ask them another question. And I promise this is the last one for you guys. So again, there will be a poll on your screen that you can see, which we'd love it if you could answer the question for us as honestly as you can. So the question is acquisition a part of your growth strategy over the next 3 years? So you've got A, yes, it's already on our roadmap. B, yes, actively in acquisition. Or C, not currently. Okay, there we go. So as it looks, neck and neck on yes, it's already on our roadmap, and no, not currently, both standing at 42%, with 17% saying yes, actively in acquisition. So I think there you go. That's interesting. So let's go back. Let's talk about funding options that go beyond the traditional measures.
Sure. So when it comes to mergers and acquisitions, companies look at how do they grow, how do they expand, and when it comes to how they fund of choices. So aside from generating and holding cash from operations in a very traditional way for acquisition, some of the more traditional options include taking on debt, selling assets of the company, issuing more equity, and operational cost-cutting measures, which unfortunately usually include layoffs. So while each of these tactics have their own pros and cons, unfortunately, each of these are typically can be counterproductive and costly if not managed appropriately or have a strategy on how they can continue to grow and manage the cash flow and operations of the business. So while companies need to be investing in strong balance sheets, infrastructure and in-store capabilities, innovative R&D capabilities, and so forth, cutting them usually isn't a good option. So while managing debt on the balance sheet is a way to fund M&A, with the rising interest rate environment that we've been in for a little while now, the cost of carrying that debt is overpowering the return that companies are looking for. So companies need a strategy to pay that debt back and pay it back quickly. What I'm finding now is as interest rates are rising, a lot of the companies we work with are trying to improve their balance sheet by looking at more innovative ways to unlock capital, leveraging supply chain finance. So one of the ways that we look at companies that are going through acquisitions and maybe haven't been able to show the success that they intended, and one of the examples we would give would be around Campbell's. So Campbell's borrowed $6 billion to buy the snack food company Snyder's-Lance. And to do so, they took on a fairly significant amount of debt and unfortunately weren't able to effectively pay it down quickly. So when you look at the results of that, we see that Campbell shares are trading back at around 1996 levels, and they're currently carrying almost $10 billion in debt. Recently, they announced that they're selling off their international foods and fresh food division in order to alleviate some of the portion of debt that they used to finance the acquisition. So while consolidation is historically high right now, a company that doesn't have a sound strategy and ability to execute on that strategy to pay down the debt that they've used to make those acquisitions, they can sometimes do more harm than good in the long run. The simple fact is that the world's best companies are looking at more innovative ways to manage working capital and generate cash from strategic acquisitions. And after all, these acquisitions are intended to not only expand the footprint, but really deliver value to shareholders in the form of growth, dividends, and operational cash flow. It doesn't mean that they're not focused on traditional fundamentals, but that they're leveraging strategic initiatives to find a way to create a win-win in the supply chain. They're finding it gives them a real edge in the marketplace. So instead of those types of alternatives, we're recommending supply chain finance implemented the right way. And here's a little bit about how we do that. When we talk about implementing supply chain finance, it has to have a strategic initiative and a focused goal that's both significant and achievable for the company. And when they look at doing that, it's got to be rolled out in a way that's both impactful to the business without harming their suppliers, but also has a sustainability aspect to it as well, in a way that can help the business continue to grow and sustain and support their suppliers and customers. So while Campbell's may not have taken the best approach, we work with several companies that have done it very well and continue their acquisition strategy. I'll give you an example. So one of the large consumer products companies in the food and beverage industry that we worked through went through a significant acquisition where they were highly levered and needed to repay the acquisition debt quickly. So it required numerous funders to cover their suppliers around the globe. So what they chose was to work with PrimeRevenue and be able to deliver a solution that were able to leverage 5 funders, integrate 2 ERP systems, leverage currencies around the world, and also do it in a time frame that was quickly impactful to the business. In this case, they were able to go live in less than 60 days. So what it allowed them to do was to generate over $750 million in free cash flow in the first quarter of deployment that allowed them to go through what's really quite an astonishing credit upgrade twice in a single year. And what this allowed them to be able to do was not only generate the cash flow and delever, but the effect of the improved credit rating allowed them to reduce their interest carrying costs across the entire enterprise, ultimately setting them up for another large global acquisition that they paid nearly $19 billion for. So being able to not only have a strong strategy, but also the mechanism and the partnership to execute on that strategy quickly and effectively is really giving some of these companies an edge in the marketplace.
So, Brian, or Matt, I guess. So for someone who hasn't had a supply chain finance program in the past, how does this work? How would they go about getting started?
Well, I guess I'll take that one. So just in the same way that there's been disruption, I guess, in the food retail industry, there's a number of different ways that you can go about getting SCF. You can work with your banks, or you can work with technology providers who are a little bit more funder agnostic. But in essence, SCF, unlike traditional factoring where a supplier wants to finance its receivables, supply chain finance, or reverse factoring as it's sometimes known, is like a mechanism where suppliers can finance their receivables through the true sale of that receivable to a funder with credit appetite for the ordering party or buyer. And because it's a true sale and not a financing, the supplier can then accelerate payment on their receivables at the lower rate of interest than other forms of financing. Typically, because the funder has a confirmed look through to the order party's credit rating as opposed to the supplier's. So what I mean by a true sale, well, for a funder to purchase a receivable as opposed to finance it, the buyer has to confirm the invoice or payable. And typically that's done by the buyer uploading the invoices of eligible suppliers to a technology service or platform. Once uploaded, the supplier can log in to their own secure portal in the platform, view the available invoices, and elect to sell some or all of them. Once an election to sell has been made from the invoices, those invoices, along with the suppliers of that ordering party that are eligible, will be channeled to the funder's purchasing portal in the platform. The funder approves that invoice purchase, and payment is made to the supplier for the invoice value less the applicable funding rate the next business day. The supplier is now able to mark down that invoice as paid, and the buyer is now obliged to pay the funder on the due date of the invoice. So supply chain finance can be one of the cheapest and most efficient ways to fund your business because it's a sale of a receivable and it's not treated as debt on the balance sheet. As I mentioned in my introduction, I've been sort of fortunate enough, my time here to work with 5 large food retail companies in EMEA, and last year we processed 25 billion in their cost of goods sold. We've seen suppliers accelerate payments by some 109 million days in that time, which is kind of a ridiculous ethereal number, but contextually that kind of translates to suppliers accelerating payment by an average of 48 days per invoice whilst trading 83% of their available invoices. So all in all, supply chain finance has been proven to help sort of protect those supply chains and provide funding tools that they might not otherwise had access to.
Yeah, it's a great point, Matt. And another thing that I would point out is that supply chain finance is also important to the post M&A health of a company. once they've made the acquisition, and let's say they've gone through and repaid debt, they still have to integrate that new company and extract value and optimize that business as well. And so as companies become bigger and they start tapping into changing consumer preferences and emerging markets, it also gives a greater risk of exposure. One of the things we look at is companies like Nestle and Danone have relied on strong growth in emerging markets to provide an uplift in their overall financial performance. Unfortunately, growth in some of these markets, like China and Brazil, for example, are beginning to slow due to an economic downturn in the region, saturation, commodity crisis, other kind of global events that are going on in the market. So it can introduce risk as well. For example, Danone bought Whitewave in 2016, and since then, the growth of that acquisition has been, well, somewhat underwhelming. Also, we see companies that as they become bigger, they have the tendency to become less agile, both from an organizational of let's get things done perspective, as well as from a financial perspective. So as we mentioned earlier, sometimes it's easier just to buy the growth than it is to try to create it yourself. By buying the growth, it gives companies the ability to maybe make a little more investment than if they were to build it, but also be able to know that they've got somewhat of a proven track record. They can avoid some of the pitfalls and some of the mistakes that some of the more agile entrepreneurial business owners and innovators are doing in the business. So it creates a win-win situation in that regard. So we also find that some of the companies mostly all have objectives around paying down debt today. Whereas a couple of years ago, the focus was largely on share buyback initiatives, returning cash to shareholders, really demonstrating that value to support stock prices. At the time, money was historically cheap and easy to borrow, meaning debt was easy to acquire, but now it's much harder to unload sometimes. So we see a focus shifting to strategies on how they can pay back much of the debt that was accrued during that time, and the interest carrying costs that go along with it. So consolidation can really help leverage the power to drive inefficiency out of the business and kind of leverage the synergy that the two businesses can have together, whether that's by being able to do more with less, to leverage distribution networks or channels that you didn't previously have access to, or really just acquiring and being able to take advantage of the, I guess, the combined brain power of the two companies to get new ideas and innovation. For companies that are struggling to pay off the debt that's amassed in the M&A process, if supply chain finance wasn't part of the plan originally, it can still come into play post-acquisition and be a powerful solution to help pay off some of the money that's been owed, and also create cash flow towards operational improvements that just simply cutting costs and creating efficiencies operationally just can't do. So the point we're trying to make is that the need for better cash flow and liquidity is crucial. It always has been, and it will continue to be so, not just for completing the M&A process, but ensuring that there's cash available to fund strategic initiatives, growth, and innovation going forward.
Okay, so the final slide here is your list of key takeaways. And at this point, we're going to open it up to our floor, our audience. So for any burning questions that you would like us to, or like me to put to Matt or Brian. We've had a couple come in already, so I'm going to kick off with those before we get going. But as I say, the floor is open. So if anybody wants to ask a question, please do send it through your chat box, through your questions box. So first of all, I think I'll put this first question to Brian, if that's okay. So can you tell us, can you get this through? Can I get this through my bank? Sorry, I don't know why I tripped over my words there, but
no worries. Sure. I mean, it's a common question, and certainly and the answer to the question is sort of. So, you can certainly get supply chain finance and liquidity and financing for your suppliers through a bank in your bank group. But what we look at for companies that are really driving innovation and they're actively in a merger or acquisition phase of their business is that they're really looking to develop a comprehensive solution. And while the banks play a critical role in all supply chain finance programs, because, I mean, quite honestly, they're providing the liquidity that makes the program work and provides the financing, what we have found is that these companies, much like the companies they're acquiring, really take a best of breed approach in that they really look for companies that are able to provide excellence and innovation in the areas that they're most proficient in. And from a banking standpoint, that's the liquidity. But what we do find is that these companies, like their supply chains and like their suppliers, are global in nature, and they have a constantly changing landscape of what their needs are. And when you take a step back and you look at the companies as a whole, they typically look at a strategy that leverages many of their banking partners. It's not just one partner or two partners. They generally have a number of partners that are providing their banking needs. And the same holds true for supply chain finance. So we're able to leverage, by using a funding agnostic solution, it allows you to leverage what the banks do well and provide that liquidity for your suppliers, but then also get the benefits of an innovative solution that allows you to leverage technology, people, services, and process so that not only can you have the funding available for your suppliers, but you can also understand how to develop that strategy we talked about and be able to have the partner that can help you execute on that. Because at the end of the day, the liquidity without the results doesn't deliver the working capital that these companies are looking for.
That's great. Thanks, Brian. Okay, this next question I'm going to put to Matt. This sounds like it's risky to my supply chain. How do you prevent harming supplier relationships with key strategic suppliers?
Sure. So, I mean, I think part of that is answered by the data that I provided in the last sort of question. You know, we already see in the food retail space that, you know, suppliers are trading 83% of the available invoices and accelerating payment by 48 days. So they're seeing tremendous value in this solution itself and the tool. I think, you know, most of the buyers that we work with, I mean, they're all fairly socially conscious to the extent that they want to be a preferred buyer. There is a status. One of the big value drivers that they see with supply chain finance is this is actually a tool to help them protect that supply chain. They understand the pressures that suppliers can be under for cash flow when invoice, you know, days payable, days sales outstanding can be, you know, in the tens of days. So I think they understand that, and I think that supply chain finance, it helps bridge that gap rather than harm those relationships. In fact, you know, one of the more recent success stories we've seen is one supplier was able to fund a completely new production facility as a supplier to someone in food retail in the last 12, 18 months. So I think that's something of a myth, but that's not to say that buyers, going back to the point that Brian made earlier about having, you know, a significant and achievable target and goal and having buy-in internally across the organization, the treasury, procurement, and IT, everyone are aligned and they understand the impact that they're going to have upon the business and what they need to do to work towards that goal. I think that, you know, I think our mantra or our philosophy is that this is a win-win situation that we work towards with the suppliers.
Yeah, that's really helpful. Thanks for that, Matt. Okay, so I think one final question I'm going to put to Brian. So unless anybody else sends anything in, we've got a few minutes. What if I acquire a business in a different jurisdiction? How does SCF support this? Good question.
Oh, that is a good question. And it's something that we do see quite often because we mentioned earlier that many companies are looking to expand either into emerging markets or they're expanding into businesses that may be sourcing or have a different sourcing strategy than they currently do, that would not only take them into different markets, but also takes their suppliers into different markets. So one of the things that supply chain finance does to support this is by definition, supply chain finance should support suppliers where they are and do business how they do business. And that typically leverages a multi-funder or a funding agnostic strategy that allows for the most efficient solution, not only from a funding standpoint, but also from a supplier adoption and a supplier onboarding and management standpoint. So one of the things that supply chain finance can do to help with that is it allows for you to continue to do business with suppliers in the way that suppliers are used to doing business, receive payments in the currency that they're used to doing business in, and being able to support the agreements in the countries and jurisdictions that they're in as well. So one of the things that becomes a critical factor in being able to help execute if you expand into a different jurisdiction, whether it's through acquisition or even just expansion of organically in the business, is to be able to have a program that can grow along with you, that also is able to scale the way that your business and quite honestly, the market, like we just talked about today, is dictating that you scale. So we've seen a number of businesses do this that may have started, let's say, for example, just in one country or one region. And then over the years, as the market has grown and their business has changed, whether through acquisition or just through organic growth, they've been able to expand into new countries, currencies, and jurisdictions through the use of supply chain finance, so that the benefit of that is extended globally to them and their suppliers.
That's great. Thank you. So Matt, just a quick question for you. What growth do you see with Amazon in the food retail sector? I think that's one everybody wants to know.
Well, I guess if we're looking in my crystal ball, I think they'd love to solve for the fresh food, but I think that's also something that it resonates with all food retailers. You know, there's the food retailers are looking at the e-commerce, but they're also looking at how we get better distribution and of the fresh foods and demands from the consumers. Amazon failed, or certainly didn't succeed with Amazon Fresh, and I think that their strategy with Whole Foods, which may not be fully evolved yet, will help us see where they want to go with that. But I would think that the targeting of delivery and fresh food products from Amazon will be the big thing that they would want to solve for.
Yeah, I think you're right there. Good heavens, yeah. Well, great. I think that's all we've got. Oh no, we've got one more question that's popped up. That's fantastic. So I'll open this up to Brian or Matt. Do you think the latest wave of buying alliances and M&A will drive a greater number of manufacturer M&As?
Yeah, I'll respond to that.
Thanks, Brian.
You know, I think it's a great line of questioning too, because as you see companies similarly from a retail and a consumer standpoint, I think also what you'll see is the ability to deliver those products, the ability to create those products, innovate those products further downstream or rather upstream in the supply chain is going to see a similar process. Because one of the things that we have seen is companies want to be able to respond more quickly and be more agile to their customers, whether their customer is an end buyer or their customer is a retailer. So from a manufacturing standpoint, what we're seeing is as companies are able to create and leverage more investment in manufacturing, they can shorten the lead time and the product development cycles when they can produce in country or produce more closely to the end user or their customer, which may be a retailer. And customers also have preference. We look at trends around preferences for customers. They are showing a preference for locally sourced items, locally manufactured items, both in EMEA and in the Americas. So I think it's a very good point. And we also see traction in the manufacturing industry as they have a large direct material spend and a complex supply chain that, you know, as we mentioned earlier, is certainly in need of cash flow and working capital.
Fantastic. Thank you very much for taking that one for us, Brian. I think we've definitely come to the end today. So ladies and gentlemen, thank you very much for sharing your time with us today. So I'd like to ask all of you to say a big thank you to Brian and Matt. Thank you both for sharing their insights and knowledge today. And I really do look forward to hearing from you both again in the future. And a goodbye to our listeners. And thanks again for joining us. And thank you to everyone at Prime Resource. Thanks a lot. Bye-bye now.